Good morning, everybody. Mike Tedeschi, investment strategist over at Perspective Wealth Planning, with this week's video, in which we're going to be taking a look at the major four U.S. indexes, the emerging markets, the U.S. dollar, and we're also going to be taking a look at the commodity index. Now, before we get into any of that, let's kind of talk about what's happened here over the last couple of weeks. From a news perspective, we've had the trade wars ramp up and continuing to ramp up, and in fact, this morning, the S&P 500 is actually set to open about 1% lower at this point in time, putting our opening price somewhere around right here at the moment, putting us back near those lows from last week as once again trade war stuff heats up overnight. Now, trade war became a very big concern back in here. And in the beginning of the year, all that concern kind of got pushed away. Yes, we're working through things, we're getting closer to a solution, etc. And then right in here, once again, those talks started to ramp back up again. So the concerns that the market had last year are once again back center stage. When we think about things on a technical analysis side of things, we have a potential double top. We've got two areas of the market where we've traded up to, we failed once, we traded up to again, and now subsequently we have failed again. Now, from a psychological perspective and from a technical analysis perspective, we now need to pay very close attention to these major levels. And the reason is because a lot of people are watching the lows from last week and this 200-day moving average, this zone that's right in here, this zone right here. This zone, if this zone were to break, that would kind of open the floodgates. When we think about how markets work, when we have a potential double top, what typically tends to happen is we tend to pull back and we tend to base and we tend to create flags. And that's what we're doing right here. Now, people that still believe in the all-time high and we're going to continue to rock and roll thesis don't mind buying this dip right here. That's kind of why we set this flag up. They think that we just run up into resistance, we're going to regroup, and then we're going to make that next push. And so a lot of bets get made in this flag. And as soon as this flag breaks to the downside, those people start to go, you know what? Maybe that's not going to happen, and that's why we get that sharp move down when this flag breaks, if it were to break to the downside. So what we're paying attention to here is this zone. It's very, very important. If we get back up over this 29.54, the inverse happens, right? So all the people that shorted and now look like they're being vindicated here, they'll continue to press their shorts in, but if we get back up over those all-time highs, they will cover. That creates buying pressure, and that drives us higher. So when we're looking at where this market is currently at, this is a very, very important zone. It's a very important range. It's one we need to continue to pay attention to. But right here on the S&P, it's basically 2,800 all the way down to that 2730 zone is this major area of support. And on the upside, anything over 29, really 50, would give us that breakout to the upside. And so, again, support is a zone. It's not a number. And you can see the importance going all the way back here at the top end of this zone. All right. We failed to break out earlier this year. And then what did we do? We tested the bottom end of the zone, which also happened to be the area right here, which we struggled at, which was the 200-day at the time. So we've got multiple areas of support and resistance that are in play right here at this 2,800 level, and it's pretty wide open underneath all the way back down to 2,600, where we have the support levels that come back into play from where we bounced last year those 3 times before ultimately rolling over, and then the next level of supports all the way back down at those lows. That is the structure that we have here in this market. So we're going to continue to pay attention to the headlines, see if these trade wars continue to heat up. And ultimately, at the end of the day, regardless of what the headlines are, the charts are going to give us those clues. And right now, we are looking at a very good potential double top setup. It is not confirmed. We would need to, again, break underneath this level right here. And then I could safely say that at least in the short term, we have put in a double top, and we're likely in for some rough waters for the rest of the year. Let me take a look at the rest of the indexes. Right, here's the lines that we have drawn on our chart from last week's video. Right, here's that false breakout on the NASDAQ. Here's the support zone. It's still holding the support zone. Now this morning, we're set to open up on the NASDAQ at that 73.40 zone at the moment. So that puts us right at that zone of support. So Thursday, today, the 23rd, is going to be very, very important. But the lower end of that support zone is really that 7200 level. And again, we can see from going back in here the important price action that was put in right here. These two rejections of that low wick there. So this is that kind of support zone in on the NASDAQ. Now, we take a look at the Russell. The Russell this morning is set to open up at 1517 or so. So right about here on this chart. Right? If we get underneath that 1500, that sends a very sharp signal here, in my opinion, that we are in a risk-off environment. Right? We have traded nowhere near those highs on the Russell. We have spent the majority of the last year under the 200-day moving average. In fact, there's only a few sessions here over the last couple of weeks when the 200 moving average had actually fallen far enough that we traded above it. We have closed 1 day total over the breakdown spot of 1600. And again, that level is important if we extend this out to the left, going all the way back to the beginning of last year as well. So we have traded nowhere near that 1750 high. And that weakness has always been a concern for me. The other area that weakness becomes a concern for me is in the emerging markets. We're going to get to that here in just a second. But let's finish up the major U.S. indexes here with the Dow Jones. Double top as well. Still holding that support zone. So, I mean, again, the bears have not broken the bottom end. So just like we talked about last week, all right, we've basically spent this week trading inside that range. So we still need to stay vigilant. Coming back in on the Russell, again, a break under 1500 would put that risk off mindset in play. And when we look at the emerging markets, we had that big bounce at the beginning of the year. And we can see where our lines were drawn, in the middle of last year, that 1100 was going to be a resistance zone. And I believe we put this line on the chart way back in here. And sure enough, that acts as the resistance zone. This previous area of support from the original breakout back in the beginning of this year, and that attempt, and I'll zoom in so you can see it, this attempt to make the breakout at the end of last year, which was met with failure, that zone we're now underneath. We have broken underneath of that. We're back under the 200-day moving average. It's pointed down once again. And let me clear all these drawings off so you can see a clear chart here. Let's look at this on a weekly time frame. Right? This is a sharp downtrend. We got a bounce, and now we have subsequently have rolled over. Let's look at our fib retrace levels on this as well. And you can see we failed right at the 50% retrace level from the sell-off in last year. Right? And when we talk about this a lot, market goes 2 steps forward, 1 step back. And what that means is 2 steps, in this case, down, 1 step up. Right? It doesn't get all the way back up to those highs. It just retraces half of the move. And then a lot of times you will see that follow through once again in the original direction. MACD is crossed over. And RSI on a weekly basis is still well above 30. So it still has room to once again continue to fall. The emerging markets to me is also important to take a look at. It's another risk-on area of the market, right? When things are good globally, people are willing to put their capital into riskier assets, i.e. The emerging markets, where the returns can be much, much better in good times, but has a lot of challenges and is a much riskier area of the market to play in. So the fact that we have made that push higher earlier this year, that failed directly at that 50% retrace level, this major resistance, and now we're back under the 200-day moving average with all of the moving averages pointing down, is very concerning. So if we're watching the emerging market index here, last year's lows, that 930 is very, very important. Underneath of that, that really would create a very negative scenario. Now, the last two things that we want to talk about is we want to talk about the U.S. dollar and commodities. Now, the U.S. dollar, we have talked about this level as being very, very, very important. And we are still trading right up into it. We have not made that breakout yet. We have been a slow, steady kind of grind higher in the U.S. dollar this year. Not a ton of volatility, pretty compressed range in on that, but it's trading right there at that major level. When we back this chart out, remember that puts us right in the middle of this range. If we can look at it like this, it's really what we've done. We've traded inside this essentially range here for the last couple of years. And we are right there basically at that midpoint. So this is a very important level for the US dollar, because if we do make a break above that, I do expect that we go back up and test that kind of 103, that high zone from 2 years ago. So we're going to continue to pay attention to this right here. It hasn't made the move yet. It's right at that important level, so we'll continue to watch it. We're going to take a look at the commodity index. This is the Bloomberg Commodity Index. It's made up of 22 different commodities across 7 different sectors. No individual name in this space takes up more than 15% of the index, and they all make up at least 2%. So it's a very diversified, broad look at the commodity space. And we are trading at multi-year lows. So like almost the inverse of the US dollar chart at the moment. But we have slowly kind of made that grind down here, and we are testing those lows. And again, if we pull the US dollar back up, right, you need the US dollar testing those highs from a month back. So kind of an inverse looking chart. However, this is a very, very important level, and again, the U.S. dollar and commodities, they do have a relationship and a correlation there, but it does not necessarily stay intact at all points in time, so you can't always go to the commodities in an inverse relationship where commodities have a positive correlation to the U.S. dollar, right? Since they are priced in the U.S. dollars, as dollars get stronger, that is a headwind for commodities. As the U.S. dollar gets weaker, that is a tailwind for commodities. But commodities have their own supply and demand issues across the board as well. When we take a look at a lot of the metals lately, they have not been performing well. The industrial metals, all right, silver, copper. Over the last month, copper itself is down almost 12%. And copper is another one of those telling components that we can take a look at for the overall health of the economy, since it's important in many industrial uses. Usually if copper is not doing well, that can tend to kind of forecast a bit of a slowdown globally in terms of development and growth. It's not, again, that relationship there is not perfect either, so I can't always look at copper prices and go, the world is ending if it's going down, or the market's going to go up forever if copper is going up. It's just kind of that canary in the coal mine. It's something to pay attention to, and it looks very similar to this chart, where really over the last month it's made kind of a waterfall sell-off there. So the commodity index as a whole is something that we're really watching, because across the board they're all testing that support zone for the last 3 years to lows from earlier this year, and this is a very, very important zone. If we get a breakdown underneath of this, i.e. if copper were to continue to fall another 10%, that is not a good sign for the overall health of the market and actual growth. So we're continuing to keep our eyes across the board to really find out and really pay attention to what signals the market is giving us, so that we can help better position ourselves for the rest of this year. I hope you guys always find these videos helpful, and if you ever have any questions, feel free to reach out and ask. Share this video, have yourself a